price is ever only doing one of two things. Price can be said to either be 1, offering fair value in the form of a fair value gap or internal range of liquidity, or 2, offering external range liquidity in the form of a swing high or swing low. Once you understand that price is only ever doing one of these two things, several very important theses can be made about price delivery inside of any range. So today I'm going to do a quick mini lesson on how I use a displacement range and this idea to gain an understanding of where the draw on liquidity is with context of fair value gaps, swing highs, and swing lows. So let's start with a general schematic of what this dealing range or displacement range looks like. Say we have 2 points, A and B. If there exists a fair value gap between point A, which is going to be defined as the origin of that displacement, and point B, which is going to be defined as the swing high or low that is put in from that original displacement, we can say that if there is a fair value gap that is contained within point A and point B, a fair value gap being an internal range of liquidity, price is either going to do one of the following things. Price will either come into this internal range of liquidity where it will find support and move higher, therefore targeting the liquidity that rests at point B. This will be defined as our external range high. If price fails to find support at this internal range of liquidity that exists between point A and point B, we can say that the draw on liquidity becomes the swing low that put in the swing high at point B. Therefore, the draw becomes the external range low. Another way of saying this is that for any displacement range in the market, points A and points B, we can say that if price fails to offer fair value and move from IRL to ERL, it will instead draw into the external range lows that created that high and that fair value gap. So let's take a look at a few chart examples to really add some robustness to this analysis and show how this can be used on multiple time frames to derive a bias. Let's start with a clear example of a continuation from the internal range to the point B, or the swing high that is created. So here is an example of a fair value gap on the weekly chart of ES where price again has 2 points. Point A is going to be the external range low, which we can denote here as point A. Point B is going to be the external range highs, which we can denote again here as point B, the external range highs. And inside the range of point A to point B, we have our characteristic fair value gap. This is an internal range of liquidity on our weekly chart. So our job as analysts now becomes to determine if price is going to create a higher low and then move higher, moving from the internal range of liquidity to point B, or if price is going to come back and revert the range and instead target point A. What we will use is something called Timeframe Analysis to determine if a short-term reversal is happening inside of this internal range of liquidity. Remember, a higher time frame continuation is going to look like a lower time frame reversal. So as price is creating a high and then a higher low and then a higher high as a continuation, on the lower time frame, price is going to look like a reversal outside of that key level, i.e. the internal range of liquidity. So for this weekly gap, we're going to use a 4-hour chart to determine if a reversal is occurring. What we look for in all instances for a reversal is the following. 1, we want to see SMT inside of this internal range of liquidity. In this case, it's the weekly. Now what we want to see is a change in state of delivery on this 4-hour chart. We want to see a market structure shift and some displacement higher. These 3 criteria or characteristics are going to define the short-term reversal that is happening that will eventually act, right, as the buy side of the curve to target this original consolidation, which is going to be point B, that weekly external range high. So as we can see, if we pull up a NASDAQ chart and we look inside of this internal range of liquidity, the first thing we want to see is if there's any SMT at these lows inside of the gap. So as you can see, price comes in, liquidates this low on the NASDAQ and fails to liquidate this low on the S&P. This becomes our smart money technique, or SMT divergence, and now what we're looking for is a change in state of delivery on the 4-hour. A change in state of delivery is defined by the series of consecutive down close candles that form this SMT. So price moves above these consecutive candles. It also inverts this fair value gap, this inversion PD array. As price does that, we can see we get a market structure shift above this high, make that a different color, and we also get, like I said, a characteristic displacement in the form of a fair value gap. This could be a trade opportunity, again, targeting that weekly external range high, risking the rejection block low, for example. So that's an example of how price moves from the internal range of liquidity to the swing high. Let's take a look at the second example, right, and show when price fails to offer internal range, how it will instead target the swing low that put in that swing high. So again, let's use another example. Here we can potentially use the weekly chart again and look at this price leg in here, and we can look at these fair value gaps. So as you can see, we have two examples of where price fails to offer internal range of liquidity within a defined displacement range and instead offers the swing lows that create those gaps. So as you can see, let's start off by defining our point A and our point B. Point A is going to be this swing low. And we'll call it point A. Point B is going to be the swing high, the external range high, right? That is created in this displacement range. Inside of this displacement range, you can see that we have created two fair value gaps from this low to this high. What we can say now as an analyst is that if price fails to offer fair valuation inside of these gaps, the draw on liquidity will become the swing low that created these gaps and this swing high. Instead of price creating a higher low and moving higher out of these internal ranges of liquidity, we are saying that price is failing to find support and will instead, right, draw into the low that created the high. Price is trading from range high to range low. So how are we going to confirm that these inefficiencies will fail? Well, we'll do the same thing we did in the prior example by looking at the associated lower time frame. As you can see, as price comes into this inefficiency, right, do we have any significant SMT at the lows? Let's check. So this is our first fair value gap. Price draws into this fair value gap right here, and it forms this large SMT. So that's a first sign that price could potentially be reversing. However, what do we fail to do? What we fail to do is we fail to shift structure, right, significantly above these highs. So we get this change in state of delivery right here, as you can see. Great. But what does price do? It comes back into this imbalance, does not shift above or invalidate this imbalance, and then there is no fair value gaps created in this range higher. The only fair value gap created is this one down here, which is utilized to run out the high, where we form more SMT divergence, right? Up in here, we form a divergence inside of this array, and then price comes back down into the range lower. Okay, so now we've said that this fair value gap has failed. Likewise, we can do the same analysis for this weekly imbalance below. So as price draws in, you can see that the consecutive series of down close candles into this key level would actually be shifting above this high. Price does not shift above that high, and instead finds resistance at this volume imbalance before invalidating this entire displacement higher, which is showing us that none of these fair value gaps are supporting price higher, and therefore price wants to seek the other side of the range. So because we do not shift delivery state, we do not get a market structure shift above this high, we now know that our draw on liquidity is this swing low. This was the swing low on the weekly chart that created these two imbalances, and as you can see, price comes back into it. Okay? We'll do one more example of this just to really crystallize kind of this failure to provide internal range liquidity or fair value and then attacking the lows or the highs. So let's take a look at another clear example of where an imbalance fails. So as you can see in here on the daily chart, we have this daily imbalance. Now as price fails, so our displacement range is going to be again point A and point B. Instead of price making a lower high and then attacking point B or drawing into the external range from the internal range, we can say that if price fails to offer fair valuation inside of this internal range, that point A, the original high of this displacement range, will become the draw on liquidity. As you can see, we have a daily key level and we have no hourly realignment of order flow that's bearish inside of this key level. Instead, we get displacement higher, and the minute this daily PD array is invalidated, we can now say that the draw on liquidity becomes this daily swing high. As you can see, price draws into this daily swing high before consolidating again. So those are a few examples of how I utilize this concept. The idea that one, price is either going to be offering IRL, which will then trade to ERL, or two, offering a swing point, one side of the range. We can use this analysis, right, to determine that if fair value gaps hold, we can anticipate the highs, right, above the fair value gaps or below them to be the draw. And if the fair value gap of a displacement range fails, we can anticipate the low that created that fair value gap to be the draw on liquidity. Hope that was helpful. Let me know if you guys have any questions in the comments. Thanks.